You read that correctly, folks. And you're probably not going to believe this, but the Federal Reserve is being pushed to bail out hedge funds once again when the next market crash hits. It's not an if, but a when. And we're talking trillions of dollars in massively risky trades here, folks. Trillions of dollars in risky trades that could tank the entire global economy. This is not a conspiracy theory. This is straight from panels of financial experts, and it's happening right now. We're going to talk about this in depth and explain what's going on here with firms like Citadel, Millennium, and others, how they almost crashed in 2019 and the government bailed them out then. What else is going on with them, including Citadel being forced into discovery and court by NWBO, UBS laying off, actually already fired a ton of their bankers and didn't give them their bonuses, and quite a bit more. So let's check this out. Welcome to the Butcher of Wall Street, where we uncover the crazy financial stories that are going on right now. Sorry about my dog. No idea what she's so mad about. But this is actually what's going on right now. All right. Seeing we got her to chill out a little bit. Welcome to the Butcher of Wall Street. Let's uncover some of these crazy financial stories going on right now, folks. We're diving into this bombshell. It's a report from Bloomberg Hedge Week, Zero Hedge. It is all over the place, titled, "The Fed has been urged to bail out hedge funds during the next market crash." Trillions of dollars in basis trades are at risk. Let's unpack this insanity and see what's really going on. So here's the deal. There's a panel of financial experts currently urging the Federal Reserve to create an emergency program to bail out hedge funds when the next market crash hits. Because these hedge funds are sitting on a ticking time bomb called basis trades in the $29 trillion U.S. Treasuries market. Let me break that down. Basis trades are when hedge funds put tiny price differences, bets on these minuscule price differences between treasury bonds and futures contracts. And they use insane amounts of leverage, borrowing tons of money to amplify their profits. How much is it? Well, folks, I have Citadel Securities statement of financial conditions right here. And you're probably not going to believe this. So take a look at how much notional value they have. Now, notional value can be deceiving because it is the amount of value, not the amount of value at risk, but the amount of all the derivatives contracts, the gross amount. But if we take the gross value and multiply it by 1,000,000, as it says to do so, you can see here we've got hundreds, thousands, million, billion, 923 million dollars worth of OTC cleared gross derivatives contracts alone. And when you include the interest rate contracts, we're looking at over $944 billion worth of notional securities in derivatives, toxic derivatives, of which are bilaterally netted against each other, meaning that one contract will offset against the other. But what happens is if not all of these can be actually bilaterally netted, then you've got some serious issues. And what we're looking at here, in case you didn't know, with the basis trades are when hedge funds drag down the entire financial system. This has already actually happened before, folks. A lot of people don't know this, but this happened in 2019 during the repo apocalypse, where the overnight rates spiked to insane levels. And when they do, they don't just hurt hedge funds, they can drag down the entire financial system. Back in September of 2019, the Federal Reserve had to step in because the lack of liquidity caused massive chaos in the repo markets. And now experts are saying to the Federal Reserve, you better have a plan to clean up this mess when it happens again. And they're not just talking about a small bailout. We are talking trillions of dollars at risk, far from pocket change, right? What's going on, Bilbo, Ron, Argos, Maynard, Jaina? Ladies and gentlemen, welcome back. Beverly, my friends, thank you very much for joining me here. This is the kind of money that could make or break the economy. And you're probably thinking, why do I care about some hedge fund pricks losing money? Well, the fact is that they're investing your money, your 401ks, your pensions, your thrift savings plans, IRAs, ISAs, etc. And it's not just their fancy yachts that sink when they fail. It's your money, your savings, your pensions, your retirement plans, and your future could go down with them, especially if you're due to retire anytime within the next decade or so. And here's why. The U.S. Treasury market is the absolute backbone of the global financial system. It is considered the safest, and I see that with air quotes, the safest asset in the world. And if that market crashes because of these risky hedge fund trades, it's like pulling the rug. It's rug pulling the entire economy. Stock markets will tank. Banks will freeze. Clearinghouses and brokerages would collapse. And suddenly, you can't get a loan. Your 401k and pensions are toast. And the cost of living skyrockets because the government has to print insane amounts of money to fix this mess, causing hyperinflation. And get this, CEOs, such as the CEO of Morgan Creek, said it best. Too big to fail is back. And this time it's not the banks, it's levered financial institutions, end quote. And he's talking about hedge funds that have gotten so big and borrowed so much money that their failure would cause a massive domino effect in the global financial sector. And guess who's expected to foot the bill? You, ladies and gentlemen, the taxpayer. Just like it happened in 2019 with the with the repo facilities crashing and the Federal Reserve having to take over it permanently. Just like it happened in 2021 with AMC, GameStop, SLV, Silver ETF, and dozens of securities squeezing hedge funds and brokerages to the point where they had to make these stocks position close only. We are seeing a repeat of this, except on a much grander level. The Fed wants to bail out hedge funds with your tax dollars in order to save billionaires while you struggle to pay your bills. Now, we've seen this movie before, right? In 2008, the Fed bailed out the banks. In 1998, they bailed out a hedge fund called LTCM. And now they're setting the stage to do it again, after recently in 2019, bailing out the banks and the repo facility. And then in 2021, bailing out the clearinghouses, the hedge funds, the family offices, the banks, the brokerages. by allowing them to take over 50 different securities and make them position close only, meaning they took away your ability to buy, only let you sell, but they continue to let themselves and their hedge fund buddies buy in order to prevent themselves from complete insolvency. Because firms like Robinhood, firms like IBKR and Webull and Schwab lent out so many of your shares and allowed rehypothecation, which means the reborrowing of the same share of your silver ETF, SLV, of your GameStop, of your AMC, of over 50 securities, that they had to prevent you from buying more in order to stop the price from going up, and only allowed you to sell in order to get the price to tank. On that same date, January 28th, 2021, they also came out with these things called tokenized securities of GameStop and AMC and these other firms that I'm mentioning in order to create artificial borrows, in order to create a way to lend out shares that didn't exist through these tokenized securities. And we saw that after the collapse of FTX, that in reality, FTX didn't hold a single share of GameStop or AMC or SLV when it collapsed. So the reality is that they abused and illegally manipulated the market and these stocks in order to lend out shares that never exist in the first place. This is why some of these firms are having so many problems. Let's talk about what this means for the future. We have three major implications, and they are not pretty. Three big problems. I'm talking moral hazard on steroids is number one. And when the Fed signals that they're going to bail out hedge funds, it's like giving them a blank check. Nat asks, how is the reverse repo up to over 290 billion again? The reverse repo operations today exceeded over 290 billion, as many of these money mutual funds are not putting their money into the stock market right now. So they are using the overnight RRP, the reverse repo operations program, in order to lend their collateral to the Federal Reserve and get it back the next day with a 0.05% interest rate. Very, very tiny. It's actually, about 0.0125 over prime at the moment. But that tiny bit is enough for them to want to stash a little bit more cash because they're worried about putting it in the stock market. Hedge funds here are taking massive risks because they know if things go wrong, the Fed's got their back. This is called moral hazard, right? It's a recipe for disaster. Hedge funds are going to keep piling on leverage, making riskier bets, and when that crash comes, it'll be even worse than before. If this is inequality, and it's going to get worse, because if the Fed bailouts hedge funds, it's a slap in the face to all Americans. Think about it. Hedge fund managers are raking in billions of dollars, selling securities that they don't own, while most people are living paycheck to paycheck. A bailout means that these billionaires get saved, and the Fed isn't bailing out your small businesses or your student loans. This widens the gap between the ultra-rich and everyone else. It's going to fuel even more resentment in the market. Mad Dog, welcome back, my friend. Great to see you. Of course, the economy is going to become more fragile. That's number three. The more the Fed intervenes, the more fragile the system gets. By propping up these risky trades, they are not fixing the root of the problem. They are kicking the can down the road, and they've been doing that since 2007, 2008, and we have reached a point in which that has become increasingly more dangerous. The Treasuries market is supposed to be a safe haven, right? And if hedge funds keep gambling with it, it becomes an even bigger house of cards than it already is. One wrong move here, guys, and the entire house of cards collapses. And when that happens, hyperinflation sets in. The economy stagnates. Interest rates go haywire. And everyday people feel the pain. Wolfie says after 2008, nothing changed. And it's finally time it did. And I completely agree with you, my friends. See, they got some. Ken Griffin was using the high-frequency trading defense on his massive basis trades. Look at all the basis points we are saving clients. Just bail us out again like you did in September 2019 and March 2020, please, says Zero Hedge. Ken Griffin said that central banks, quote, seem to be more consumed with this theory of systemic risk from this trade rather than the fact that we're saving tens of basis points in cost for the American taxpayer, which is billions of dollars a year by allowing this trade to exist. Check out the leverage in the basis trades on the markets. It has gone up quite significantly over the last few years. From when it was at only 25 to 1, it is now leverage on the Treasury repo markets increased to over 56 to 1. That's a big part of the issue that we're saying here. Zero Hedge came out with this article last year in August of 24 saying, will $1 trillion in Treasury basis trades blow up the clearinghouses? And, well, it's looking more and more likely like that's quite the possibility. And they followed up by saying, it will be hilarious if all the multi-strategy hedge funds, which are crushing their smaller peers and getting even bigger, end up in the same basis trades when we get another March 2020 Treasury market lockup. And everyone just LTCMs. LTCM is that firm that I told you about in 1998 that received a federal bailout. They said, we bring up all of this because it's almost time for the Fed's next hedge fund bailout. Bloomberg reports that the panel, as I just told you guys, of experts advised the Fed to set up an emergency program that would close out highly leveraged hedge fund trades in the event of a crisis in the $29 trillion U.S. Treasuries market. And according to experts, a vicious unwinding of the $1 trillion in hedge fund arbitrage bets would not only hamper the Treasuries market, but others as well, requiring Fed intervention to assure financial stability. When the United States Central Bank did that in March of 2020, during the initial COVID crisis, it engaged in massive outright purchases of Treasury securities to the tune of about $1.6 trillion over several weeks. And we have found since then, of course, as you guys have noticed, that to be inflationary. Inflationary in massive terms. Because anytime you print out $1.6 trillion out of thin air to bail out the banks or hedge funds, well, the American people have to pay for it for years. For years. And so the thinking goes, they continue to say, since the Fed is powerless to regulate several multi-billionaire hedge fund managers and rein them in, the next obvious action is to prepare trillions in taxpayer funds for another massive bailout enema and leave them on the hook for trillions in capital just so the billionaires can keep on billionairing. And for those asking, who is behind these basis trades? We share our updated chart of hedge fund leverage among the 6 largest multi-strategy funds, all of whom are known to aggressively participate in basis trades. The regulatory capital of just the big 6 multi-strategies: Millennium, Citadel, Bailout, Point72, Exodus Point, and Lighthouse. Just the big 6 is a record $1.5 trillion. That's an increase of $300 billion from last year. Folks, these guys haven't closed out their positions in the basis trade arbitrage here in the treasuries. They haven't closed out the majority of their short positions all across financial markets, especially in stocks like GameStop, AMC, and SLV, the silver ETF. They haven't closed out their short positions on precious metals and many others out there, which, of course, could all blow up in their face at a moment's notice. And what is far more scary is that the average regulatory leverage, or the ratio of regulatory assets, their leveraged exposure, to assets under management, or the actual tangible capital, as I showed you guys here, has increased from 6.3 times a year ago to 7.8 times, reaching a new record. Here again, as I stated to you guys, we have the notice to statement of financial condition for Citadel Securities swap dealer, the most recent financial condition notes that we have as of December 31st of 2024. And as you can see here, there is a massive amount of toxic derivatives in which they are currently gambling, much like UBS, much like Credit Suisse, much like Archegos. And we know what happened to Archegos and Credit Suisse. And now UBS is holding that bag. And for the very same reason that Citadel and Point72 invested billions of dollars in buying out Melvin Capital's short positions, they're going to have to do the same things here in these basis trades. And it's going to get to the point where they can no longer continue to do that. And everything blows up in their faces, and the Federal Reserve is likely to have to bail them out. Bilbo says, I'm moving my trading accounts to Lit Exchange soon in the near future when they launch. I can't wait to leave the places I trade now. Lit Exchange is going to fly. Imagine the other brokerages trying to compete. No payment for order flow. No payment for order flow from price distorting dark pools. At the same time, Citadel is now being yanked into court. The market makers that are being sued by NWBO, Northwest Biotherapeutics, are headed to discovery. We've been covering this for a significant period of time, and their attempt to get the NWBO case completely thrown out has been rejected. As we can see here from this March 26th, 2025 memorandum from the court, it is ordered that the motion to dismiss filed by G1 Execution, Lime Trading, Virtue, GTS, Citadel, Canaccord, and Instanet, for the foregoing reasons, the court adopts the R&R in full, and the defendant's motion to dismiss is granted in part and denied in part. Defendant's motion is denied with respect to plaintiff's alleged stock sales at prices derived from closing prices on dates when spoofing episodes occurred. Defendant's motion is granted with respect to plaintiff's remaining stock sales, meaning that the court is going to look heavily at spoofing and the stock sales prices of NWBO by these firms stated above. It is so ordered, signed by Judge Gregory H. Woods on March 26th, 2025, entered March 27th, 2025. As you can see here, the report and recommendation has been adopted, and Northwest Biotherapeutics is, in fact, taking Citadel and these other firms to court, and we are going to be seeing a lot of information come out, I believe, in discovery, which is great news. NWBO is one of several firms that are currently suing market makers and hedge funds for market manipulation. Another one that we have been recently talking about is Quantum Bio Pharmaceuticals. And QNTM is the stock ticker. At one point was worth over $1 billion and has been shorted so heavily that its value has been reduced to under $10 million, around $15 million now. We are going to be having, actually, I've already met with and had an interview here with the CEO and CFO of Quantum Bio Pharmaceuticals, and I will be airing that coming next week. So be on the lookout for that. And they give us all of the details and their thoughts on the naked shorting and the market manipulation that occurred against QNTM stock. Let's see if we can't get a hold of the people over at NWBO as well, even though I have a feeling that they may or may not be able to talk about it, considering they're currently going to court against these defendants for their market manipulation allegations. Now, folks, let's talk about UBS and HSBC. But before we do here briefly, let me give you some more background on this basis trade. You can see here, for those wondering why a blowup in the $1 trillion basis trade would almost certainly require a Fed bailout, is because the inherent leverage in going long cash and shorting futures is anywhere between 20x and a 56x. You can see the regulatory assets from 2023 and 2024 for these firms, and their regulatory leverage has also increased quite significantly. Look at their leveraged funds, the returns in the Treasury basis trades. Peak to trough using 20x leverage multiples are massive. They said Harvard University's Jeremy Stein, who is a former Fed governor, said, if the Fed is tempted to buy again, we'd rather they do that on a hedged basis. This approach can be a valuable addition to the policy toolkit at the Fed. Now, Bloomberg is documenting the key source of risks to address this so-called basis trade, where hedge funds seek to profit from tiny price gaps between treasuries and derivatives known as futures. And they continue to say that it is a pretty concentrated trade involving perhaps 10 hedge funds or fewer. And if hedge funds need to unwind their basis pair trade positions quickly, similar to what they did in September 2019 and March 2020, when the move itself crippled the entire bond market, the danger is that bond dealers will not be able to handle the enormous sudden volume of transactions. And consider this, when the Fed had to intervene in 2020, the basis trade was roughly $500 billion. Compared to today's over 1.3 billion. Now, they continue to say to relieve the stress on dealers, it would be sufficient for the Fed to take on the other side of this unwind, purchasing Treasury securities and fully hedging this purchase with an offsetting sale of futures. Ironically, the paper recognized that bailing out hedge funds, similar to what the Fed did after LTCM in 98, after the September 2019 repo apocalypse, and again in the depths of the COVID crash, would raise questions, including the moral hazard, where the existence of the facility could potentially encourage hedge funds to take on even more risk. Now, I found this to be very important here. They continue to say that he's right, and yet when the next crash happens, one of those not if but when things, funny I said that earlier, quantitative easing, QE, money printing, is precisely what the Fed will use again, because it is a known and effective way of bailing out the entire financial sector. Brett Montgomery says, I've been in NWBO for 7 years. Citadel has been shorting it forever. The amount of criminal activity by the market maker is unreal. The time has come. It does definitely seem that way, my friend. It absolutely does seem that way. Now, I did mention UBS in the title, but I miswrote it. I should have written HSBC. So my apologies for that. But HSBC has fired a ton of their investment bankers on the day that they're supposed to get bonuses and gave them no bonuses. Ladies and gentlemen, this right here screams we have no interest in hiring anybody for the next decade, because no investment banker is going to want to go work for HSBC when this is currently happening. Nobody. Now, I do have to wrap this up, but as you can see here, HSBC fired investment bankers on the day they were due to learn their bonus figures and gave no bonuses to many they let go, in a sign of how the bank is taking a more ruthless approach to costs. Now, they said that a lot of bankers were losing their jobs, but I don't think that many of them expected it to happen on the day that they were going to get their bonuses. Other investment banks sometimes pay bonuses to those whose positions they terminate as part of restructuring programs, even if they're smaller than usual. But they've been so determined to make significant cost savings that last month they unveiled the goal of saving $300 million and cutting $1.5 billion from their annual cost base by the end of next year. If they are doing so well, why is it that this has to happen? Why is it that HSBC is laying off such a massive amount of investment bankers and paying them absolutely nothing? Nothing, folks. That should give you a big indication of just how bad things are at some of these firms. And I did have a UBS post over here. My computer is lagging for a moment. Now, in case you guys didn't know, the Senate today did in fact vote to crush an IRS broker rule. Now, it's about the Senate voting to kill an IRS rule that would have forced decentralized finance crypto brokerage platforms to snitch on users' crypto trades. This shows a bigger picture. The government and the Fed are picking winners and losers. On one hand, they are cracking down on regular people in crypto, trying to track every trade you make. And on the other hand, they're ready to bail out hedge funds when their risky bets go wrong. Do you see the double standard? The little guy gets squeezed while big players get a safety net. And this is infuriating. This is why so many people are fed up with the system. So what can you do about this? Stay informed. The more you know, the better you can protect yourself. Don't put all your eggs in a basket that the Fed might accidentally crush. And third, let your voice be heard. Share this video, comment below, and tell your friends what's going on. We can't let the Fed continue bailing out billionaires, and brokerages continue to bail out their hedge fund buddies. Because of that, we have launched Lit Exchange. So far, over 350 retail investors have invested over $650,000 in Lit Exchange, which is an upcoming stock and crypto brokerage created to protect you from market manipulation and deliver bleeding edge innovations to redefine trading, to avoid dark pools and to avoid price distorting dark pools due to payment for order flow, to avoid retail investors' trades getting front run by the same market makers and the same brokerages that are selling and buying your orders in order to process them in dark pools and rehypothecate your orders, rehypothecate your shares. Protect your financial investments by no longer allowing commission-free trades to dictate what you're doing. Because guess what? They're not free. You pay so much more that, in fact, the Securities Exchange Commission fined Robinhood $34.1 million because they found that Robinhood was lying to their customers. Robinhood says that your trades are commission-free, but in reality, even accounting for the fact that you didn't pay a commission, retail investors lost over $60 million more than they would have otherwise. If you had just paid a few cents, a few fractions of a penny or a few pennies, or even a few bucks for a massive trade, you would have saved so much more compared to the commission-free trades in Robinhood. Ladies and gentlemen, I will leave you at that. You can go to litexchange.com. You can see the Lit Exchange filings on the SEC Edgar website as well, and get all the information there that you need regarding our Regulation C and D filings. There is also a link to the company pitch deck, business plan, etc., and all the other disclosures directly on the Silicon Prairie funding portal site. They are a FINRA regulated funding portal in which you can invest in the private equity firm Lit Exchange. And when Lit Exchange goes public in the future, as planned, then you would have a liquidity event. And if you don't know what liquidity event, I highly suggest you look it up. Cheers, folks. I got to go pick up my daughter from school. So I wish you peace and wealth, and I will see you again tomorrow. Cheers.